You can see from this long-term graph on the central banks that they continue to buy gold at the highest levels recorded. What does that tell you? That tells you that they know that they are destroying whatever little bit of confidence yet remains in the market, because rapid inflation with all the mental manipulation that goes on, that will, and the loss of confidence, that's the key. It's that confidence piece that will cause the hyperinflation. Now, quantitative easing is money printing for free. So dropping the interest rates all the way back down and then just spewing out money. But as we've noticed, and that started in March of 2009, and every round of quantitative easing after that has less and less and less impact. So even when they do it now, it's kind of like pushing on a string, and it is not stimulative at all. Something comes up and I get to prove a point that I'm making. I love that. Obviously, I love that. And the point that I want to talk to you about today is a confirmation of the growing trend where the physical gold and silver markets will ultimately be determining the price, and the physical markets as a supply and demand real pricing tool versus Wall Street's. So here we go. I mean, back and forth. So one day gold hits a new week high as U.S. data boosts rate cut expectations. What does that mean? Well, when the Fed pushes the interest rates down, then that's better for gold, right? Because it makes the dollar weaker, okay? But you know, on the flip side of that, gold falls as bet on Fed cut waiver with data gap clouding view. So the point is Wall Street actually wants you to think all of this crap matters. Well, physical markets don't move that rapidly. The paper trading markets do. And so that's why they call spot gold gold and spot silver silver. It is neither one. It is merely a contract representation. And I am, by the way, based on the question that I had last week, so I will be showing you a chart on silver and where support is.
A striking development recently emerged. Gold and silver prices surged even as ETFs recorded significant outflows. Historically, ETFs help suppress upward movement by absorbing investment demand. But now prices are rising despite Wall Street selling pressure, a clear indication that physical markets are overpowering financial engineering. This paradox is a sign of structural change. ETFs, once considered the benchmark for precious metal sentiment, now represent a shrinking share of total market activity. The real weight comes from over-the-counter trade, global exchanges, and direct physical acquisition. These forces are gradually recalibrating price discovery toward tangible metal rather than paper promises.
But this is the piece that confirms that shift from the paper markets controlling the price action to the physical markets controlling the price action. So I was really excited when I saw this. Gold and silver surge amidst ETF outflow. And this is a market paradox. Okay, so what does this mean? Well, let me show you. First of all, they are referring to the spot markets because they never really want you to think of anything other than the spot markets of having validity. But can you see down at the very end of that, I just drew a square around there, how the ETF, Wall Street's used the ETF to manage, it's one of the tools that they use to manage the price. And I'm going to show you something in just a second, but bear with me. You can see the major outflows in ETFs at the same time that the spot price continued to go up. That's just a teeny little trigger that most people would never, ever notice. But the reality is, it is a confirmation of this growing structural shift in the gold and silver market away from the paper markets and into the physical markets guiding the pricing. So I'm super happy to hear it. It doesn't happen like that. So as I come across it, or if you come across this, share this in this forum. It's a great place to do it since we're live.
While retail investors debate short-term moves, central banks are quietly making their strongest statement in decades. They are buying gold at record levels. This aggressive accumulation signals a loss of confidence in fiat currencies and a recognition that monetary experiments, especially mass money printing, carry long-term consequences. Every round of quantitative easing has become less effective, eroding trust in financial stability. Nations preparing for currency resets historically turn to gold to anchor value during monetary transition. Today's buying spree reinforces that pattern. Gold's role as a monetary asset is already being restored, regardless of whether the public is told so openly.
But I also wanted to point this piece out, and boy, it's really small, so forgive me on this. But this is the cross-asset markets for gold. See that little teeny weeny line up on where that arrow is? Okay. Well, that's the ETF market. The over-the-counter market, the OTC, and the exchanges are far, far bigger than that itty-bitty OTC market that we can see it, or not OTC, the ETF market that we can see it. So the shift is absolutely happening. It continues to evolve. And frankly, I look forward to the day when it is the true supply and demand market that is giving us accurate pricing. Now, do I expect Wall Street to ever tell us what the true fundamental value is? Well, not for a very long time. But ultimately, yes, because when the central banks need to regain, or the governments make an attempt to regain your confidence as we are in that hyperinflationary event, then we will see gold begin to move toward its true fundamental value. You can see from this long-term graph on the central banks that they continue to buy gold at the highest levels recorded. What does that tell you? That tells you that they know that they are destroying whatever little bit of confidence yet remains in the market, because rapid inflation with all the mental manipulation that goes on, and the loss of confidence, that's the key. It's that confidence piece that will cause the hyperinflation. Now, quantitative easing is money printing for free. So dropping the interest rates all the way back down and then just spewing out money. But as we've noticed, and that started in March of 2009, and every round of quantitative easing after that has less and less and less impact. So even when they do it now, it's kind of like pushing on a string, and it is not stimulative at all.
Inflation is no longer a theoretical risk. It is an accelerating reality. When public confidence erodes faster than policymakers can contain, the stage is set for hyperinflation. History shows this shift happens when money creation becomes detached from real economic output, pushing people to seek assets outside the financial system. Governments often respond by tightening control, including indirect forms of confiscation through taxation, inflation itself, or regulatory pressure. When trust collapses completely, citizens rush toward tangible stores of value. In that moment, gold's true fundamental value emerges, often through government-led revaluation meant to stabilize collapsing purchasing power.
But I do think that what's going to drive that hyperinflation is a more rapid bout of inflation. I think we have that in the very, very near future. And that the complete collapse of confidence, that's what will usher in the hyperinflation. And the tool that they're going to use to create that money are your purchases. Can you see why it's so important to become your own central bank and to create that level of community around you so that you have surety in all of the mantra areas: food, water, energy, security, barterability, wealth preservation, community, and shelter? because whether we're being sold down the river here or we're being sold down the river there, we have to take personal responsibility for where we are in this world and what that future looks like. We can sit here and do nothing. And, quite honestly, you got to understand that is a choice. And if you make that choice, then you have to accept the consequences of that choice. Or we can come together and take our power back, which is what I think that we need to do. And that's what I'm personally fighting for. For people that don't have a voice, for people that don't understand what the real problem is. The real problem is that there's not sound money in the system anymore. The real problem is that the Constitution, where the individual was the head, that's been turned upside down. And now we're slaves to the government. We need to take our power back, and we can do that if we come together. One person can't, but 3% can.
Collectors and long-term wealth builders often focus on pre-1933 gold coins, not only for their historical significance, but because they once carried protections under U.S. law. These coins were considered rare and collectible, making them exempt during past confiscations. Their limited mintage, condition, and age give them intrinsic scarcity beyond metal content. Unlike modern bullion, which governments classify as monetary gold, older pieces blur the line between investment and numismatic history. As uncertainty grows, many view them as a hybrid asset, part precious metal, part collectible, that offers potential insulation from future restrictions or aggressive monetary interventions.
This is wealth that has lasted in families for at least 300 years, and it has 3 legs. It has real estate, truly rare collectibles, and gold. You can do all 3 with gold. The pre-33s are more rare, and because I was born in 1954, and in 1964, I saw how my Uncle Al had the ability to hold, I don't know how many ounces, but at least 3,000 ounces of gold when it was illegal to hold 5. So there are 2 things working for the pre-33s. One is the history of it. I mean, this particular coin is a 1910. It was minted in Philadelphia. Hence, it has no letter afterwards, just 1910. And it is a mint state 63, which means that it has, mint state means never been in circulation. When the coins that were minted back in 1910 were minted to be used in circulation. I don't know what the original mintage was off the top of my head, and I can't actually tell you how many are known to exist off the top of my head in this category. But the pre-33 coins were exempt from confiscation, and the public back in 1933, if they had understood the law, it said that any coin minted prior to 1933 is classified as rare and collectible. So that means even this raw coin that was minted in 1889, and you see I hold it in my hand all the time, I can throw it up, whatever.
At the core of this discussion lies a larger issue. The global monetary system has drifted far from sound principles. When currency loses integrity, individuals must decide whether to remain vulnerable or take proactive steps. Building resilience means securing essential needs, food, water, energy, community, while holding tangible assets that outlast political cycles. Gold has served as generational wealth for centuries, surviving wars, monetary resets, and economic collapses. While no single person can fix a broken system, communities can reclaim stability by understanding money, diversifying beyond fiat, and preparing for transition. True independence begins with informed, deliberate action.
You know, this is not a mint state coin, but it still falls into that classification. So what moves the rare collectibles, whether they're gold or whether they're, any other hard asset, tangible asset is quality and rarity. And where I prefer the pre-33s is because and I don't even have any here, and I'm not wearing my travel bracelet today, or at this moment anyway. But the new stuff is classified as monetary gold. In this country, gold has been confiscated 3 times historically. So much as people want to say, well, that can't happen again because gold is not part of the monetary system. Did you recall the chart of all the global central banks buying more gold than they ever have in history? Gold is actually very, very much part of the monetary system again. And what I know for sure is desperate governments do desperate things. And since in this country we've had gold confiscated 3 times, and even today we see forms of gold confiscation happening all over the place, like royalties are a form of confiscation, taxation is a form of confiscation, inflation is a form of confiscation, and all sorts of other names that they're going to use as forms of confiscation, but without saying, oh, we're confiscating it. Guess what? It's hard for me to imagine that at the very end of this confiscation that they've done to you your whole life, that they're suddenly going to go, we got enough. Excuse me. You can hold the rest of your wealth. It's okay. We're not going to confiscate. I can't tell you that there will 100% be an overt confiscation because I don't know that for sure. But what I do know is that even if history doesn't exactly repeat, it absolutely rhymes. And every single country has a gold revaluation account. And every single country, 48 of them, that has gone through what we are going through right now has reset the price of gold, that is all intrinsic value since it's used in every single sector of the global economy, against this garbage that has absolutely zero value, only has any value at all because you agree to work for it. What's the difference between this and a bill that you would get out of a monopoly game? You agree to work for this. That's the only difference.